We have one more presentation, and this is on investing in early stage innovation, which Abijit is going to tell us, hold your seats, it's risky. Well, I guess we probably already knew that. But you're in the investment management business, aren't you?
Yeah.
But you took a course at Columbia. Was that at CEPA or someplace?
It was absolutely, Tom. That was with CEPA, and that's when I also met Peter. And it's been I've been following the Wall Street Green Summit ever since, and it's a commendable job of actually doing something consistently for 2 decades. It's a great opportunity for me to actually be a participant speaker at this session, Tom.
Okay.
Yeah.
What would you like us to know?
So, I mean, I think one of the important aspects, I guess, when we're talking about, and I think this is encapsulating all that we've been discussing over the last 2 days. We do understand that we are going on an energy transition, a transition to a cleaner economy, where just like we've seen in the last 20, 30 years, we've literally transitioned to a digital economy due to the innovation that was there in the 80s, 90s. A similar transition needs to be there where we're all actually subscribing to a certain form of innovation that has become quite commonplace in other sectors. So why has that not happened in clean tech is largely what I'd like to cover. And also specifically talk about the differences as to why a venture investing model that used to work for a good period of time, spurring digital innovation, has not largely worked for clean tech. And how I would like to go ahead with this is, firstly, what's interesting is if you see between 2005 and 2011, almost about $25 billion were put into clean tech per se by venture investors, of which a little more than half was completely eroded, and about 90% of them never returned capital. Fast forward the last maybe 10 years, we've seen quite a bit of growth and a new momentum, and there was, you got Cleantech 3.0, 4.0, etc. So there's been a momentum. At the same time, the renewable energy capacity globally has actually increased exponentially, right? I mean, in the same period, it was about 150, 160% growth. So you're saying that at an early stage, we're not being able to spur as many innovations out of the lab, and as what I think Christine alluded to earlier, and Turaj mentioned yesterday, is the market value of death, where there's a lot of sinking happening. And that's an area where you could call it the missing middle as well, that it is not able to really attract the kind of capital required for them to scale from a seed, Series A and beyond. So to illustrate why, possibly based on my experience, and a quick upshot of my experience, I've been in the venture space, venture management space for the last 8 to 9 years. Started off in a deep tech venture investing firm in North Carolina, Introverse Capital, and after that I've been part of 2 stellar startups in the clean tech space, one actually in water, the other in food and beverage, out of MIT, and then subsequently over the last 1.5 years, through Ascender Capital Partners, we've been supporting deep tech, clean tech startups raise capital and expand to new markets. Based on the work I've been, over the last 8 to 9 years, I've actually come to realize that there are 3 fundamental differences between what venture investing model says or looks for and clean tech. Firstly, and I'll quickly go through that, and then after that, of course, I have a solution, or at least what I think could be a proposed solution that could be implemented. First being the VC investing model as such, right? I mean, Tom, you're not new to this. The whole limited partner, general partner structures. What really happens in this kind of structure, and having seen many startups go through this issue while they're raising capital, is I have not met one clean tech founder getting into launching a clean tech startup with an intention to exit it in 3 to 4 years, right? There is a certain amount of reason why the and I've seen multiple cleantech founders that I actually understand that there are many other ways to scale companies. There are many other ways to find exits and return to your investors. However, the venture investing model does not allow that. We spoke again. Christine spoke a little bit about hardware. Durek spoke a lot about hardware yesterday. You know, you need hardware companies. You need companies that potentially can't exit in 3 to 4 years. So one question is the LPGP structure really affecting large scale investment? Or should we gravitate towards different structures? So that's one thing, because as we all know, GPs need a carry, etc. So is that coming in the way, and will that continue to come in the way? Yes, there's a lot of transition to patient capital, etc. But has the structure been resolved, or should we look for direct family offices, fund investing, and investment management kind of a setup? The second, and I think a huge problem that we saw, especially 2005 to 2015, was this whole hunt for game changers, right? In my experience, I've seen incremental innovation is very fair game for clean tech. You don't necessarily need to be the next so-called Ubers or uh, come something which is completely off the blue, because the market is so big and incremental innovations. Like, think about Tesla. I mean, what Tesla did, yes, it was in a new space, etc. But is it a monopoly now? Is it as monopolistic as uh, Uber or anything else? No, because the space is as big that once there's disruption, there's automatic uptake, and it's everyone can invest in. But there has been this tendency for venture investing to not look for incremental innovation, which are much more easier to scale and that are easier to actually, stay relevant and stay existent. Third is, I think, a big question about the way venture investing has happened. It's been very thematic. It's been very theme based. That's why you have these terminologies of Cleantech 1.0, 2.0, 3.0. That's not going to work. You're either in it or you're not. Just because bidding comes in, you're going to be putting more dollars to Cleantech, but just because Inconvenient Truth got released, now you want to do everything. That's not going to work. You're either in it or you're not in it, right? So the team-based approach, I think, is definitely something that has caused. And in the past, they have, as in a way, money flows like water, and if you have just too much of it, just because you're a great company and you've just got a $10 million check on your seed round, it not necessarily solves all your problems. You can get flooded, and that's what we saw, without taking names during that era. So team-based cyclical investing has actually taken pulled out money when startups needed it, or put in a lot of money when possibly startups could have grown more organically. Uh, Fourth quick aspect is the whole, and now things have changed thanks to big trendy ventures, etc. But the not in my backyard approach when it comes to investing has been a traditional concern, I would say, with clean tech, because clean tech, unlike certain on the techs, is pretty universal. It is global in nature. But we've had challenges where venture investors have not looked beyond what's comfortable for them geographically. And things have changed dramatically. I mean, I'm now in Asia. I see that there's a lot more geographical democratization of innovation happening, but I think there's a lot more needed for us to really achieve this transition that we've been looking forward, and it will start with innovations specifically. In terms of the solution matrix, I guess the way I think to really put together a model is of course challenging, and there would be many ways to once we actually understand and absorb these fundamental differences. I think there are many structures that can come in that are available. The three things that I have found that every structure should look, every investing house or family office or even a venture firm interested in clean tech should look for is a tiered approach for investing. You don't at a seed stage, at the Series A stage, money doesn't solve all problems as we discussed. So uh, if you're staggering investment on the seed stage, seeing how the progress happens and then putting it, I think that gives a lot more flexibility for you to actually uh, manage and monitor the investment and actually take them and give them resources. And that comes to my second point of having an operational focus, right? We heard Kristen talk about what Build Edison does to scale. I mean, these are what's important. Greentown Labs, there are many such entities that have now come forth that are available to provide them the most important resource at that stage of seed and Series A, which is actual CXO officers, right? People who can mentor, manage, get the regulatory clearances out of experience, and so some form of a value of debt, so that you're escaping the not just the market value of debt, or what can also be called the managerial value of debt. So second aspect is to have an operations focus, have a bottom-up approach. And third, and I think this is one of the biggest advantages, right? I mean, earlier on when I spoke about the fact that there was so much of debt capital that is chasing solar globally, why is the debt capital not coming into other forms of or other forms of clean tech? Why is it not chasing as much water projects, storage, everything else, which is and even when it first came to solar, there was disruption in the debt market, as we saw it in some instances. So the third part about it is once you've got this two-tiered staged approach, you've got an operational focus. The third thing is allow the whole new capitals, the new forms of non-dilutive capital, as well as the new markets that are available for clean tech, but honestly are not available for other sector startups or innovations. Like you can't really take as much project finance for a consumer-driven startup as you can take for the storage startup. So how do we bring in, inculcate these operational nuances? So they're creating a lot more, and this is something, again, I will allude to what Turaj said yesterday, and you really can develop a lot of startups that can scale and that can attract other forms of capital and hence return the investments and prevent further dilution for the early investors and give you exits in a different form, not necessarily exiting by the conventional definition, but by just preventing further dilution and or getting merged into a corporate venture house or even uh, launching a SPAC like it's happening these days. So just sharing a little bit of thoughts. I think this is, of course, something that is open to debate. There are offers various ways to throughout it.